From management side, we have with us Mr. Vedji Tikku, CEO ED, and Mr. Chandrasekhar, Chief Financial Officer. I would like to congratulate the entire team of Page Industries for showing a strong set of numbers. And I'll not take much time. I'll hand over the call to Mr. Vedji Tikku. Over to you, sir, for opening remarks, post which we'll open the call for a Q&A session.
Yeah, thanks, Akhil. Welcome to the Q3 business update. Our revenues for the Q3 financial 21 grew by 17% year on year and 25% sequentially quarter on quarter, aided by a very strong festive demand and of course the gradual lifting of the lockdown also helped, which helped us to increase the footfalls in our stores. Business has recovered well, and we are obviously have grown over the previous year. Our volume in the same period grew by 10% year on year and 22% sequentially. Retail stores, on the retail store front, more than 95% of our MBOs, multi-brand outlets, are all functional now. All our EBOs, 100% of them are open, and more than 93% of our large format stores have also reopened. E-commerce continues to be robust during this time. Our manufacturing and warehousing facilities have returned to complete normalcy. Our outlook for the market, the sales trends, which have been on an increasing trend since August, continues into quarter 3 as well. So we have seen a growth trend through month on month, starting the month of August till the December end, and it continues. Our branding efforts continue through multiple channels, including online media and continued focus on our point of sales, which we have done extremely well on that side during this financial year, because we felt that focus on the point of sale was very important during this year. Our kids wear business continues to be the special focus, as you are all aware. And it has shown a very encouraging customer acceptance and feedback. We now have 28 EBOs, which are exclusive brand outlets that are exclusive for our junior business. We now also have 192 Jockey Juniors specific channel partners across 174 cities, managed by a strong sales team of 150 people. We continue to expand our depth within the existing market geographies, as well as strengthening distribution in markets which are witnessing expansion of mature retail formats. Jockey is present throughout India in 2,890 plus cities and towns. We see a great potential in the rural tier 3 and 4 cities as well. We are strengthening our distribution network in a phased manner in these markets, which have a good potential and opportunity going forward. We will continue our focused approach on our core businesses, which is the men's innerwear, women's innerwear, athleisure for both men and women, socks and towel. And we are quite confident of maintaining growth going forward. So now with that, I would request Mr. Chandrasekhar to update you with the financials.
Good evening, everyone. Welcome to the Q3FY21 earnings call for Page Industries. As we have seen the numbers, there's a volume growth by about 10% in Q3. The revenues are 971 million, and the revenues have grown by about 17% compared to the same period last year. The 9-month revenues are 19,522 million. This is down by about 19%, as you know, due to the impact of a weak Q1. The EBITDA margins have been healthy at 24%. It compares with 22% in the Q2 of this year and 17.5% in the Q3 of the previous year. We have brought in a number of OPEX controls, and we are very frugal now in this year, starting with Q1 on the engagement of labor, on some of the discretionary spends in OPEX and in advertisement and so on. and that is the main reason. Apart from the very healthy top line for the EBITDA margins of this quarter, the Q3 PAT is up by 39% quarter on quarter and by 77% year on year, which means compared with Q3 of last year. So we have achieved an all-time high revenue this quarter in history of 9271 million and a PAT of 1537 million. The PAT margin is at 17%. The 9 months PAT is 2250 million, which is about 28% below that of last year. We have put in place a number of controls on working capital, budget controls, and so on. So the cash and cash equivalent has further increased this quarter by about 23% to 4941 million. And this has come about because of better management of inventories and so on. The net working capital, though, has increased to 5518 million. It was 4579 million in March 2020. The inventory has reduced, but then the cash equivalent is up by almost 3,770 million. There is also an increase in payable because of increasing volumes of business. So it has been a pretty good quarter and a reaffirmation of all that we have, the processes and practices that we have put in place over the past several years, including this year. So thank you very much. We can get on to the Q&A, please.
Thank you very much, Mr. Chandrasekhar. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Participants are also requested to limit their questions to 2 per participant. Time permitting, you may return to the queue for your follow-up questions. We will wait for a moment while the question queue assembles. The first question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good evening, team, and congrats for a very strong performance.
Yeah, thank you very much, Bhargav.
So my first question is on the raw material inflation that we are seeing with yarn prices sort of going up. So in terms of our pricing, have we taken any pricing actions to sort of pass on those yarn prices?
So Bhargav, if you remember, even in the last meeting, I had emphasized on this. So there is a tendency of the yarn prices going up towards the end of the calendar year because that's the end of the crop season. And then by the time the new crop comes somewhere in around Feb, the prices start to come down again. Having said that, yes, this year has been a slightly, the price increases have been slightly more than the averages what we have witnessed in the previous years. But it's completely under our control, and we have budgeted this increase in our overall budgets.
Okay, so we have taken price hikes to sort of pass on this inflation. Is that understanding correct? Or
we had taken some correction in last year, August, if you remember.
Yes.
And that's we have taken into consideration this increase as well. And
so
need be, if once we have go to the next financial year, we generally take one price increase every year. Okay. So we'll be looking at all these prices probably next couple of months and take an appropriate call with the price increase.
Understood. Secondly, sir, our understanding is that in kids we've already crossed about 150 odd crores. Is that understanding correct? And essentially, is it fair to say that we are trying to place our kids even with women MBOs, given that typically women customers are the ones who buy kids clothes as well?
Yeah, you're right. That is the because we also noticed that, as you rightly mentioned, it's generally the mother who buys for the kids. So it made a lot of sense for us to have, Jockey Junior selling also from those stores. We also have many stores which are, Jockey Junior stores by themselves who sell only for kids. As I also said in my, opening remarks, we also have 28 EBOs, and we have another 20 in the pipeline, which we are working on. So we also have, pushed ourselves, and we have these 174 cities already with the junior business. So yes, it's a formidable business going forward, and we are giving it all it requires during these formative years, because we know this is going to be a very large business in the next few years.
So lastly, in terms of our rural penetration, our understanding is that Jockey has come up with a rural bouquet of 5-6 products which they have designed for the rural areas. Is that understanding correct, in order to sort of make inroads in the rural market, and these products would be sort of in budget, considering the per capita income over there is lower as compared to the urban areas?
Yes, you're right. So basically we are getting into the tier 4 and the rural side. We have made a bucket, but it's close around 30 odd products. Okay. So we were doing some pilots during the last 6 months. And so, as I said, in fact, we had done some early basic small pilot in the south earlier, and now we extended to north and a few places in west. And the results have been extremely encouraging. And we are taking it very seriously this year. And, we will soon, like what we did for the kids business, we'll be soon having a separate setup for the rural business. That is our endeavor going forward.
Great, sir. Thank you very much, and all the very best.
Thank you very much.
Thank you very much. Ladies and gentlemen, we would again like to remind to restrict the questions to 2 per participant. Time permitting, you may return to the queue for your follow-up questions. The next question is from the line of Nihal Jam from Edelweiss. Please go ahead.
Yes, sir. Thank you so much, and congratulations.
Sorry to interrupt, Nihal, but your voice is very feeble. May I request you to speak a bit louder?
Apologies. Is it clear now?
Yes, much better. Please proceed.
Thank you. Yes, congratulations to the management. 2 questions from my side. Sir, if I look at the history of our performance, ideally there has been very limited seasonality in our business, even if I compare Q2 or Q3 as a performance. So specifically for the performance that we've done this quarter, could you highlight if it's specific to any product segment or any incremental category, or even, there was an issue with not enough inventory in the channel that has led to this strong spot? I'll come to my second question after.
So Nihal, it's a lot of things were done in last 6 months, because when the markets opened up, the demand pattern had changed. There was a lot of requirement for at-home wear. So in our earlier plan of this year, we didn't have the contribution of our athleisure business was obviously lower than what we have today at this point of time. So there were a lot of things done both at front end and back end. If you remember in the Q1 meeting, I had said that even when markets were closed, our team was in touch with all the retailers through phones, and we reached out to them, and we were not talking business, but we were saying if they need some support and help. So that was the kind of the connect the team had created even while the markets were closed. Eventually, when the markets opened up, there was of course requirement and demand was there. So there was a lot of work required to actually manage the supply chain. I think we did exceedingly well, both supply chain across the raw material, and then actually producing these products and reaching them to all these outlets across the countries who are channel partners. Having said that, coming back to your question, the quarter 3, as you know, generally because of the thermal wear, there is also a surge of requirement for the thermal wear. That definitely helps the business in those 3 months. So that, of course, that was even there last year. But I won't say that there was something which was specifically different than last year. I think it was a pure focus. We also, during this time, opened close to around 4,000 outlets. We have opened 7,000 till date in this year, financial year. And these were the people who were not selling jockey earlier. So all these things put together, I think it was a joint effort from across the teams, back-end product management team, the supply chain team, distribution, which helped us to actually do these numbers in the quarter 3.
That's helpful, Vijay, sir. Second question specific to Mr. Chandra. Now the kind of bifurcation you give in terms of how your margin is split between contribution, gross, and EBITDA. I'm not sure if it's available for earlier quarters. But could you specifically highlight what has led to improvement in each of these 3 segments as you look at it? I would assume the price hike you've taken in August would be one of the components, but just the fact that whether it is across contribution or gross margin, there has been an improvement. So if you could just give a little more detail on that, and I'll be done from my side.
Thanks, Nihal. As far as specific to Q3 is concerned, yes, the price increase is one of the factors. The material cost has been strong, meaning that it is not a reason for any of the higher contribution. But then we have the labor cost absorption has been better, particularly because of the high sales. Similarly, we look at the other, if you're talking gross margin, then the other manufacturing costs, which include power and other variable costs and manufacturing units, as a percentage of sales has been better. So these primarily account for the better gross margins and so also the contribution.
But I see that the increase is less than commensurate with the increase in the top line. So is it efficiency primarily, or?
It is a big factor is efficiency. For example, the labor cost is now 7.8% of revenues in Q3, as against about 8.5% in the same period last year. The manufacturing overheads are about 3.6%, as against 4.5% in the same period last year. So one, better absorption, and of course better efficiencies on the shop floor have led to these strong margins.
Absolutely. So thank you so much, sir. I'll come back in the queue and wish you all.
Yeah, thanks.
Thank you very much. The next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi, and congratulations on a very strong performance. My first question was on the overall growth. Have you seen any difference in the EBO growth that you're clocking in your own EBOs versus overall growth? And why I'm asking the question is, again, because you opened a lot of new outlets, was there some extra primary-led restocking in the revenue growth, or are the EBO trends almost similar to the overall growth?
Arnab, as I explained to Nihal earlier, so there was this is a very sort of a collective effort from a lot of sites which has led to these numbers. We increased the number of stores, which I said the MBO has increased in this first 9 months. We have increased close to 7,000 outlets on the MBO side, which were buying jockey for the first time. We have added EBOs, which is we are close around 80 new EBOs have opened during this time. So they have added to the sales, and of course the upsell of the athleisure business, which also has helped in higher revenues, because obviously the ASPs of our athleisure is almost 2 to 3 times our innerwear. So all these things put together has helped us to arrive at this number.
And just the like-to-like growth in the EBOs, is that also keeping at strong levels? Just wanted to check that from a retail offtake point of view.
Yes, it is. We have a positive growth on like-to-like as well.
Sure. And my last question was to on the margin. See, your historical margin range has been more in that 21% range. And this quarter is obviously much higher at 24. Other expenses have dropped a lot YOY, other operating expenses. So just wanted a sense of how much of this savings is sustainable, how much do you think are expenses which will come back? Would you want to reinvest this additional margin for growth, and therefore we should see more, going ahead your historical range of 21-22% rather than the 24?
Yeah, thanks for that question. The 22% is around the norm that we price post inflation and OPEX and all that. But of course, this quarter has been special due to when the OPEX controls are already in place, the volumes have taken off. But then a lot of the discretionary spend has been cut down. But going forward, you will see some of the advertisement returning, and we are going to invest again in digital transformation and all that. So all that will be for fueling the growth of this business. This year we are particularly tight on the OPEX.
Okay. Thanks. That's it from my side. All the best.
Thanks.
Thank you very much. Next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
No, I didn't have any question to ask. I just wanted to make a point that finally all the many efforts, either in supply chain, product portfolio, distribution, team, technology, cost factors, and increased fire in the belly. Finally, we are seeing a culmination into a performance that I've come to associate with Page over 11 years that I've been seeing. So very happy to note that. I hope this is not kind of a glorious exception, but hopefully glimpse of that will remain as kind of an ongoing thing.
Absolutely, Mr. Bharat. I think all the points you raised, that's what we were, continuously doing, even when we had, very strong headwinds. So all these efforts, we did get some tailwinds for the first time in last, I would say, almost 36 months now. And all these efforts, which you very nicely put across, they are there. The efforts, I'm sure, are going to stay. All we need is some support from the market, which we can see now. And, we are more than sure that this is sustainable, and, we will be taking this forward for many quarters and many years going forward.
Terrific. Delighted, and congratulations to everyone.
Thank you very much, Mr. Bharat.
Thank you very much. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Yeah, hi. Good evening. So just two questions. So firstly, while it's a very strong performance, how can we be sure how much of this is pent-up demand, given that, if you look at the 9-month performance, we're still down 19%, and I'm assuming that for a category like innerwear, the demand is not entirely destroyed. So how much of this is just any way for us to figure out how much of this is just consumers who missed out in 1Q coming back to shop?
See, Aditya, if we had grown by 50%, quarter to quarter this year, year on year this year, then probably I would have, there was some merit in what you were saying about the pent-up demand. We have to grow by 16-17%, which we very strongly believe with the kind of headroom we have in this market and the penetration levels of, below 20% in that market, which is already filtered, which I've explained many times in these meetings. So we don't see that this was, this is the regular demand which is coming back for sure. And this is something which we are more than sure is a genuine demand which is going to continue for many years to come, because we still have the penetration levels which are suboptimal, and we are just at 20% in the men's innerwear, and we're talking of 6-7% on the women's innerwear, and we're talking of around 7-8% on the athleisure business. So definitely not pent-up demand. This is something which the demand has come back. The markets have opened. We have done a lot of efforts in the market by opening new stores through MBOs, EBOs. We have opened the EBOs for even junior business. That is helping up. The socks business, has come back, which was not there earlier in the first quarter. For obviously because of, even in second quarter it was quite down. It's come back, very nicely in the third quarter. So all these things put together, we are quite confident that this is something which is sustainable and will go a long way.
Yeah. No, my question was in the context that, until about 2017, we used to do sort of more growth than this literally on every quarter. And then since then we have the growth decelerated, but then this quarter we've seen an acceleration. But it comes from the context that, obviously 1Q was a complete write-off, so some consumers from back who wanted to shop then would have come in once the markets open up. But anyway, the other point, the other question being, how much could you give us a sense of how the athleisure mix has changed, say 3Q this year versus 3Q last year?
We generally don't share the the contribution, but there has been a significant change from on our athleisure business. We have a double-digit growth at a very high level on the athleisure growth on the athleisure volume business, because I think that's something which has been the which will go a long way for Page, because I think that's been the silver lining, I would say, in this of the whole year, that there's been a huge trial of athleisure, and all these people who tried our athleisure for the first time have found a product which is a quality product, value for money, and for sure they're going to stick to this and get back. And we have seen in the past that the stickiness of our brand is very, very high. Once consumers have used our products, they have definitely come back. So we see this as this will be a very advantageous to us in the coming financial year and thereafter, because the athleisure business is something which is a very, very large contributor. It's almost coming close to our men's business. So that is the kind of contribution in the business what the athleisure business is showing. So I hope that answers your question.
Yeah, it does. The reason I asked this was, just to understand how much the growth would be in men's innerwear or women's innerwear for the quarter.
Yeah, we would not be generally sharing that for reasons because of the competitive nature. We have been sort of not sharing it at segment level.
Right, but both would be in growth, right?
Yes.
Okay, that's fine.
Sorry, you mean the athleisure business?
No. Men's and women's innerwear, would have seen growth, right, year-over-year?
The women's innerwear and athleisure are in high double-digit growths. Our men's innerwear is still slightly lower. It's not grown.
Understand. Very clear. Thank you.
Yeah.
Thank you very much. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Just two questions from me. One, I wanted to understand the reason for the increase in commissions this year. Have we increased dealer level commissions, or is it more to do with mix? And so the other bookkeeping question was that you typically take a price increase in Jan. So is that something that you're not going to do this time? I'm sorry, I missed from your earlier comments. I thought that you don't feel the need for a price increase. So I just wanted to clarify that part.
Yeah. So sorry, Avi, what commission are you talking about? I didn't get that first part.
Sir, the rebates and commissions that we give out, has that increased this year?
No, absolutely not. They are the same. So
okay,
I'm not
sure. I picked that up, so I thought maybe.
Yeah, no. So our distribution margins, our channel partner margins, so they continue to be the same what they were.
Mm-hmm. Okay.
And
okay. And so the price increase bit, I just wanted to kind of revisit your comment.
So we generally take a price revision depending on the input costs. So currently we are covered. We don't have any plans to do it immediately. But post this financial year is done, we'll be definitely looking into Although we have already budgeted, what kind of percentage increase is required, if it's required. So a call will be taken towards the end of this financial year, which should sustain us for the next financial year. Currently, whatever we did in last year, August, is good enough for us.
Oh, okay. So what we did in August is enough. So we take a typical price increase starting Jan, right, sir? Or no, there is nothing like that, sir?
No, you're right. We used to, many years back, it used to be like we used to only do it in the last quarter every year.
Yeah.
But since things changed, this was a different year. So we had taken some increase in the month of August, which is good enough for us to sustain this financial year. We'll be looking for, if required, the call will be taken towards the end of this financial year for the next financial year.
Okay. And sir, if I may, what's the volume growth number? I missed that. If you had said that number, that's all from.
It's a 10% volume growth for the quarter.
Okay, sir. Thank you very much, sir.
Thank you very much.
Thank you very much. Next question is from the line of Swagato Ghosh from Franklin Templeton. Please go ahead.
Yeah, thanks for taking my question. As you mentioned, this year you have added...
Mr. Ghosh, may we request you to speak slightly louder? Your voice is a bit low.
Yeah. Am I audible now?
Yeah, better.
Yes, please.
Yeah. So you said you added 7,000 outlets this financial year. Can you just share some more color on the nature of these, like where these are mainly situated, like at airport, cities, or like somewhere else, and also the reason why we could not reach these outlets earlier, and whether the economics of doing business with these outlets are slightly unattractive for the distributors, and hence in that case, we as a company, do we provide them some support in terms of working capital?
So first of all, these 7,000 stores are across these 2,900 cities, where we are catering. So if you do math, it's not a very big number in that sense. We're talking of probably 6, 7, 8 stores or 10 stores at max per distribution point. So it's not something which is, and they are out of the city or out of the town. So they were around. So there were many reasons. The jockey was not present there. They could be working with the competition. Probably they were not of the size earlier, and they have over a period of time grown. And the third reason was that this year, supply-wise, Page was one of the companies which was in a good position to have the supplies reach the retailers. So all these factors helped us to open these stores, and it's a normal thing. We add this number of stores almost every year, anything between 5,000 to 7,000. This year, yes, we are looking forward to open at least 10,000 stores. By the time we close this year, that was the target we set ourselves, and we already have done 7. So I'm confident that we will be opening those around 10,000 new stores by the end of this year. And there is no cost. There is no cost, additional cost for the distributor which we need to support them with.
Okay.
It's only additional business for them.
Okay, fair enough. And sir, I'm also trying to just reconcile the two comments that you made. The one is on the EBO like-to-like growth. You said we had a positive growth, but on the men's innerwear we have not grown. So yes. I'm just trying to reconcile these two comments.
No, so men's innerwear, is a large chunk of our business. So the athleisure business, as I said, is a very high double-digit growth. And EBOs, is the mix of both. So keeping that in mind, the EBOs have grown. The like-to-like growth has been there in the EBOs. And so when I said we have not grown, we are almost there like last year. So it's not that we are negative there. So it's marginally there. It's marginally short of last year on the 9 months. Keeping in mind that we had a washout for a quarter, right? So, but like-to-like growth on the EBOs is positive.
Okay, and just for a typical EBO, what is the mix right now, athleisure versus say men's innerwear?
No, they sell. You mean within the stores? Yes, EBO is close to around 40%. sorry, the figure is close around 40% in the EBOs.
Okay. Got it. Thank you. I'll come back in the queue.
Yeah.
Thank you very much. Next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi. Thanks for the opportunity and congrats on a good set of numbers. Sir, if you spoke about the demand recovery and all, but if you can give some indicative breakup of growth in the quarter between MBO channel and versus retail channels like EBOs and LFS.
Tejas, we refrain from giving those minor, micro details.
Even the indicative numbers, sir, the way you gave about men innerwear and women innerwear, this indicative number also will help versus what we reported at company level, which channels actually outperformed and which were below it.
Sorry, unfortunately, all I can tell you is that we have grown in each of these channels this year in terms of value business.
Okay. So second, sir, associated question was that a large part of our network was not available for business for 1H. And if we just have to dissect the pent-up demand part from the actual recovery, so the network which was available throughout 1H, are we seeing healthy growth in that channel as well or that network as well?
So see, all our networks were open from quarter two itself. It was only the extent they were open to. For example, our EBOs were almost 80% by the time we were in the mid-August had already opened. It was the MBOs, which was slightly on the lower side, obviously because there were lockdowns and there were a lot of areas which had not opened up. Which are almost 95% open now, as of quarter three closing. So there was not a specific segment which had not opened and which has opened now. So they had opened across. It was only it had opened, the cross section had opened, but it was the number of stores within each of these verticals, which was the question earlier, which is no more. So everything is almost 100% open now.
Sure. And so lastly, if you can give A&P spend growth YOY for the quarter and 9 months for the...
Sorry, can you please speak loudly, please? Sorry, I didn't get
Sir, A&P spend growth YOY and for the quarter and 9 months. That's all from my side.
The advertising and marketing promotion growth you're saying?
Yes, sir.
Yeah, so we had taken obvious cut during this year. As compared to the previous years. And so we, whatever was budgeted for this year, we have spent that amount for the year. And so generally, our spend used to be somewhere between 4 to 5%, 4 to 4.5%. So which was year on year for all these years, which we had obviously cut to almost half this year. And going back to 21, I think that should be back to whatever we require for our ASP budgets.
Sure. That's all from my side. All the best.
Thank you. Next question is from the line of Jaykumar Doshi from Kotak. Please go ahead.
Hi, thanks for the opportunity. You did talk a little bit about the benefit you saw in athleisure space due to new trials and increasing penetration. How frequent is repeat sales? At what point of time will you get a better understanding of how much of that trials or new customers have been are sticky, permanent, and any quantitative data that you can give in terms of which can help us appreciate the success or how you've benefited better.
So generally, it is between 4 to 6 months where you are able to see the repeat sales of any product in our category. And so yes, if you look at quarter two to by the end of quarter three, so we are talking of that 4 to 6 months time, and we have seen repeat sales, and there were some of the product lines where we actually were pushing ourselves to keep the supply chain going because the demand was so high. As I said, in the earlier part of my discussion here, we had not, as a contribution we had when we did the budgeting at the last year for the year 2021. So the budgets were obviously much lower in terms of contribution, and it took us by surprise. So we were working overtime to actually have our supplies working for this, so which is a very clear indication that there are repeat purchases for our core products, which have been there for many years. But because of these new trials, there is repeat purchase.
Can you give us some color in the 9-month period? What would have been the growth for this, athleisure portfolio? Just as a one-time this thing, I know that you don't break it up on a regular basis, but just.
No, as I said earlier, it's a very high double-digit growth.
For 9 months also.
For 9 months also, yes.
Understood. Thank you so much. That's it, and good luck.
Thank you. The next question is from the line of Akhil Parekh from Elara Securities. Please go ahead.
Hi, sir. I have two questions. One is, have we registered any market share gains in our core business, that is men's innerwear, for first 9 months of this year, or has the market in general expanded?
See, unfortunately, there is no dedicated study on the market size. So as we have been discussing it in the past also, so we have done our we have our own method of understanding the market and what our penetration levels are. So we have taken a few studies which were done at various levels, and one of them was the BCG report, which helped us to understand the Indian market, and keeping in mind the number of people which are available out there to buy a product like jockey. So our assumption is there is 150 million or 15 crore men and women. So obviously 50%, 7.5 crore men and 7.5 crore women who are our target audience. So that's what we look at, our audience. And our understanding is that we have huge headrooms. On the men's side, we still have 19 to 20% penetration levels, and 5 to 6% on the women's side. But that has not changed. It still continues to be the same even at these numbers, these values. Also from the fact that the market itself is ballooning and growing year on year. So that's what is the best estimate we have here at least.
The question I was asking was because we have seen in other categories, right, where the market shares have moved from smaller / unorganized player to a bigger player. Has that happened in our category? That's just a broader question.
That's what I'm saying. It's difficult to say that because there is no market study as such on the on the market share for our category of business in our industry. So it's more of a estimate which we make on our own through some other studies which have been done in the past, and then we are able to collate these numbers. Unfortunately, there is no syndicated study on the market share in innerwear industry.
Oh, sure. And just one more from my side, capex guidance for next year.
Sorry, what was that?
What is the capex guidance for next year, FY22?
Yeah. Casey, you would like to take that?
Yeah, thanks. We have some capacity expansion coming up planned next year. So we will be in the range around 3,000 million.
Okay. So 300 crore for the entire year.
Yeah.
Got it. Thanks a lot, and best wishes for coming on.
Thank you.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, I just wanted to understand, we heard a lot of shortages in the urban area. So was it due to the growth in the... Hello?
Arpit, your voice is not clear.
Yeah, we just heard a lot of shortages in the urban areas in the men's underwear. Was it due to the growth of athleisure?
No, there are two different lines. So they are manufactured at separate places. So it's nothing to do with the growth of athleisure. Yes, as I said, the demand was slightly higher than what we had envisaged to start with. But by the time we're talking now in the month of January, we are almost there. Our stock days are improving, and it's on the basically it's a matter of another 1 month, and we'll be at normal levels in terms of our supply chain for men's innerwear. That has been a little issue for the last 2 to 3 months.
And sir, you heard it correctly that the athleisure revenue contribution and the men's innerwear contribution was the same for this quarter?
No, I didn't say the same. I said it's almost catching up to the men's innerwear, in terms of revenue.
And given that most of the offices and everything is opening up currently, would you be able to maintain the base for the next year quarter for athleisure?
I very strongly believe, I have been asked this question from probably 50 quarters, and I have repeated yes, and we have, all the time proved it right. So I hope we'll prove it right in coming quarters as well.
Okay. And what will be the sustainability of this EBITDA margin going forward, around 24%?
24%, but we pitch for around 22% minimum quarter on quarter. Sometimes all the quarters volumes are not equal. There is a variation in the margin, mainly due to the labor absorption and overhead absorption. At the same time, the raw material prices do fluctuate. As Vegi was explaining, towards the end of the calendar year, the yarn prices look up and then they gradually come down. So on a whole annual basis, our we always maintain 22% EBITDA margins are better.
And can you throw some light on the rural areas products that you are planning up onto?
Yeah, so as I was explaining earlier, we did some pilots in last almost I would say 18 months now. So we lost that 1 quarter in between, which was the first quarter of this year. These pilots were done in the rural sites across the zones, north, south, west, and even one part of east. And the results were very encouraging. So we have chosen a bouquet of products from our large portfolio, which we feel is the right product mix to start with for these small markets. And so we are currently planning to have a strategy which will be headed by one of our senior managers, and we have a plan that in the year 21-22 we will be pushing the rural side, and so I would not be able to share the complete details, but we have some big plans to push our foothold into the rural markets now.
And just to follow up on that, what will be the difference?
Sorry to interrupt, but maybe please request you to return to the queue for your follow-up questions, as we have several participants waiting in the queue. Thank you. Next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So my first question is on the men's innerwear. Did I hear correctly that there was a slight decline in men's innerwear volumes for the quarter, or was it for 9 months?
9 months.
And for the quarter, we would have still posted growth?
As I said, we generally refrain from answering these questions, but I gave these details because there was some understanding had to be done. So I would restrict to the 9 months. So obviously there has to be growth in the first quarter too, because we had a washout in quarter 1 to be almost at par for the year at quarter 9 for 9 months year on year. So yes, there is we are also the fact that this is the largest volume what we sell. So that also we kept in mind. We are just a shade below the average. Sorry, there's a lot of disturbance. Can't hear you.
Sir, I've done that, sir. You may proceed.
Sure. So I think I heard in the past that, for 9 months, obviously, we would have seen a decline, given that the company level we have seen a 19% decline. So So the number which you said was for quarter 3 because athleisure would have grown by high double digit.
Yeah.
And so going forward next year, do you think this growth in athleisure is sustainable, or we might see some correction and demand slowdown wherein your innerwear business takes, a growth trajectory?
So innerwear and outerwear are two different products and they have two different usages. So there is no way that an innerwear can eat into the outerwear or vice versa. The requirement of both these garments is very different. So I don't see that that's going to have any impact on either of them. Coming back to your other question of sustainability of the growth of athleisure, I would say definitely yes, because the kind of trials which have been generated this year will only help the cause there.
Sure. That's helpful, sir. Thank you.
Thanks.
Thank you. Next question is from the line of Sameer Gupta from IIFL. Please go ahead.
Hi, sir, and thanks for taking my question. Congrats on a very good set of numbers. Most of the questions have been answered, so I'll probably ask a more strategic kind of a question, sir. So, this e-commerce, we have also seen the fruits of consumers adopting more of this channel in the COVID times, and this is across categories. But what's your take? At least in your core urban markets, where the salience of e-commerce is growing, and there are so many premium and foreign players now which can enter and access this market. Probably they don't need to build the kind of distribution that you have built because of the flexibilities offered by this channel. So do you think of this as a threat? This is more like a thought sharing exercise, sir.
No, Amit, I appreciate your thought. It's not that we don't think about this or we don't discuss this internally. See, we also have a very strong e-commerce wing, right? Where we have our own shop, which is jockey.in. Then we have we sell outright to all the biggies of the e-commerce world. We also sell through marketplace through all these guys. So it's not that we are not available on that side. So if somebody is going to go to the internet to buy a pair of innerwear or any athleisure products, it's not that we are not available there. We are there. And when it comes to value for money and the pricing of the products, the quality of the products, we are up there. So it's not that somebody else can come from nowhere and produce a product which is much more superior than us at half the price of us and take over the market. I don't believe it will work like that. It takes many years. It took us 2.5 decades to arrive at this value proposition, create this kind of a quality product, and the aura and the marketing around the brand of so many years. It just doesn't vanish overnight. Then the kind of presence we have offline, which in turn helps the online business as well, because we are talking of attaining 1,000 EBOs very shortly, probably in another 6 to 8 months. We should be having 1,000 EBOs, which is just second to Bata in the entire apparel and footwear world for a single brand. So that's the kind of reach this brand has. While we can look at the e-commerce business, as a threat, but we see that as an opportunity because we are available there and we have all the products which we sell offline available online, and as I explained, we sell through all these players who are selling the other brands from their portals.
Appreciate the detailed answers, sir. Thanks and all the best.
Thank you very much.
Thank you. Next question is from the line of Ashish Kanodia from Ambit Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, in your opening remarks, you made a comment that there was a month-on-month growth trend since October till December, And if I heard it correctly, the trend has continued during the January. So can you confirm that? And second thing is, when I look at your men's innerwear, not recovering back to 100%, we have already, added almost 10 to 12% stores. So that could have also given you some growth, right? So what kind of, delaying your recovery in the men's innerwear, given it's more essential in nature?
So question number one, yes, I confirm what I said. We had a sequential growth from August month onwards till the end of Q3. That's been continuously happening. We have grown more than the previous month as a percentage from August onwards. The second part of your question, sorry, I missed out. The second part of the question was?
So the second part was that, we have already also had a 10 to 12% footprint in terms of, retail outlets, and yet we have not been able to recover. So what kind of driving a delay in recovery in men's?
No, the only thing is we have to understand here the base of our men's innerwear is the largest in terms of volume, right? So it obviously, because when we lost one full quarter of a very large base, it's not very easy to come out of it in just 6 months. But by the time we close this year, I'm sure that we should be in a much better position on demand innerwear also.
Sure. And second question, so sir, on the first question, I think I missed your comment. Has the growth trend continued in January as well?
I should not be commenting on January. Yes, it is till December. It has been consistently growing.
Sure. Okay. That's all from my side, sir. Thank you.
Yeah, thanks.
Thank you very much. Due to time constraints, that was our last question for today. I now hand the conference over to Mr. Akhil Parekh for closing remarks. Over to you.
Thanks, Zed. On behalf of Elara Securities, I would like to thank everyone, and especially the management of Page Industries for answering all the questions very patiently. I'll hand over the call to Chandra sir just in case of any closing remarks.
Thank you very much, everyone. It's a well participated conference as usual, and also we learn a lot from you equally as we share about Page Industries. Q3 has been good, and we hope the good times will continue. But thank you very much. Have a good day.